Welcome to the Closing Bell. We're back with you this week. Jason Jacobi, Mark Boyer. Boy, do we have an interesting one for you. We're going to make it interesting on a boring topic. We talk a lot about inflation, right, Mark?
I'm so sick of inflation. Not only because it's eating into our wallets, but also just sick of talking about it. It's always a subject, right? And this week is a big subject this week with the numbers that came out.
Absolutely. That's a good point. We're all sick of talking about it, hearing about it, but we want to put an interesting spin on it this week. So we want to talk about, is Fed policy actually tight? Is it a tight money supply? Is this consistent with tight money? Have we seen the economic slump that would be associated and consistent with a tight money supply and tight money policy? So we'll dive into that in a second, but let's take a quick look at where we finished for the week in the markets. Dow Jones finished the week down 2.37%. S&P finished down over 1.5%. NASDAQ actually was kind of the big winner on the week. It was only down almost 0.5%. S&P, which is the Russell 2000, was down 2.89%. So again, down week for the markets. Nice little downdraft. Obviously, we talked about maybe this is a good kind of breather that we're finally starting to see after an incredible run this last year.
Oh man, we've had a run we've had a long run since early November, right? So we're due for a pullback. We've talked about that in the past. We're not surprised. And it never feels good. Anytime you see red like you got, like we're seeing right now, we've had 3 days in a row of really volatile numbers, right? You're down 500, you're up 450, you're down 500. It's like, what's going on? So now the market is just trying to, there's just a battle going on about, where interest rates are headed. And really, when do they, again, we've gotten to this place in the market where only thing people look at is, is the Fed going to cut rates? It's all about that all the time. And it's, I think some other things get lost, like important things like earnings per share, things like that. I think today on this Friday, JP Morgan came out, with, they beat earnings on, on their, for their quarter, but they sort of guided much lower than the market expected. So that was, I think that kind of added to today's, drop off. It's interesting. The Dow's been and again, back to the Dow has been the worst hit of the indexes. If you lose that, the NASDAQ looks pretty strong. S&P still above its 50-day, as is the, let me see, where did Dow end today? Did it end up above? Let's see here. Dow's clearly, we're down, we're down 2%, 2.3% from their 50-day moving average on the Dow. So that's pretty weak. We don't want to be under there. And we're down 5% from its high, which is only, which was only back in March, kind of March 21st area. So we've had a lot of damage in the Dow. Those big industrial, large cap companies that are highly leveraged, a lot of them. So they've gotten hit. Hit, because interest rates have, spiked back up to that 4.5 range this week. So anyway, damage there. We'll see how it plays out. But not unexpected, but not fun to work, to go through for anybody, because, it could continue, and then it could actually start to, be that little snowball, right, that starts to roll downhill and gets bigger and bigger. So, that's why, looking at what we're talking about today is pretty important. We'll see how we got a lot to digest the rest of this year.
Absolutely. And we'll get into CPI and PPI, the inflation numbers on the consumer and producer side of things in a second. But I think it's worth noting, bonds, we've talked, and if you have a wealth manager, you've talked with one, or even yourself have been watching the 10-year, which is kind of like the bellwether. It's kind of one that we watch pretty closely. A few weeks ago, we were down at 4.3 and change. Now we're up to 4.99, you had just said, correct? So quite a bit of a jump.
No, 4.5. We're right at the 4.4.
4.5.
4.499. Today we actually closed right below 4.5%. So 4.5 is kind of like the market's going to, the 10 years going to kind of dabble around that. If it gets much higher and stays there, that's not really great for interest rates in the short term.
Gotcha. Sorry, I misheard you there
Yeah.
before the
Yeah.
recording here. So
Or
4.499. So we're
yeah.
hovering right there at the all important 4.5, and we'll see where it goes. But I think again, so we're gonna work our way towards the method behind the madness, the kind of ending point behind the race here that we want to really focus on, which isn't just inflation, right? So consumer price index came out this week, prices that consumer pays. In my opinion, not as important as PCE numbers, personal consumption expenditure report, which the Fed actually watches a little bit closer. But you know, we had headline CPI come in this week. We had it at about 3.5. So, it was a little higher than expectations. And then
Yeah.
core CPI, which excludes, volatile food and energy costs, came in at 3.8%. Also, 10 basis points higher from expectations. So these numbers, not catastrophic, but they do signal quite strongly, in my opinion, that the hotly anticipated June rate cut that everyone was talking about and hoping for, that was kind of help rallying the markets. Are we cutting rates? Are we cutting rates? Don't think it's going to happen. We've talked about that, right, Mark?
Yeah, no, we've said that. It's higher for longer. That's kind of the new phrase everybody's talking
Mm-hmm.
about. And it seems like after every inflation report, it was more and more people are jumping on that bandwagon. So, yeah, I mean, we've been talking about, we didn't think they would probably cut rates till second half of the year. And, basically this week, I think, and we'll talk a little bit more about this, I know, in this podcast, but, it looks like the June rate cut looks to be like kind of tabled, and that's but we don't know that for sure, but the market is kind of pricing that in right now, that there will be no rate cut in June.
Yeah.
There's still some ideas, that maybe be two before the end of the year.
Yep.
I would say that might even be aggressive to think. I mean, this thing
Yeah.
could be, maybe we get one, I don't know, two or one, I don't know yet. But I mean, the fact is, it doesn't seem like at the moment that, that what we thought was the tight, if the Fed was tightening, if it's tight enough to really impact the economy. And right now it doesn't look like it has been. So all that pushes out the fact that, we're going to be higher in here for longer. And that's what the markets they're grappling with right now.
And I think that's a really good segue, Mark, that you're mentioning. Are we tight enough? Is the money policy tight enough, even with where we're at in the economy? I mean, you had, the PPI numbers come out this late this week as well, which is the producer prices that are being paid. That was up as well. Of the year over year numbers, month over month was actually fine. The year over year, though, was the kind of disappointment that kind of seemed to point to what we're going to talk about here in a second. But you look at headline numbers, 1.6 to 2.1, so half a percentage point. That's a big jump. And then core PPI as well skewed upward, 2.4% this morning, from an upwardly revised last month of 2.1. So let's talk about what we're going to get in. Go ahead.
Yeah, and all of those saying that, like, that's going the wrong direction, from 22, like 9% inflation, and we had this sort of supply side issues with COVID and all that,
Yep.
eventually worked its way through. Inflation has dropped, pretty significantly since then, but yet
Mm-hmm.
now we're in this place where if we're trying to get to 2%, and yet we keep edging
Yeah.
back up now,
Yeah.
that's the kind of thing that's not where the Fed goes. But again, interesting. Okay, and I'm only bringing this off from memory. We talked about it. So it's interesting that when you look at the long-term inflation trend over time, over the last 90, 100 years, it's been anywhere from 3 to 4% on average inflation over that period of time, which is where we are right now.
Yeah.
And you and I talked about this long ago. The Fed has, in the last 10 plus years, sort of had, created this 2%, goal on
Yeah.
inflation, right?
Yeah.
And yet the longer term trend has always been 3.5 to 4. It's like, well, so is somebody wrong here? I mean, can we do life at 3.5, 4%? I mean, what I mean? Can we still function? And that's where I think everybody's trying to figure out. You young people, and I say, because you could be young, but you didn't live through the 70s and 80s like some of us did, and
Right.
where mortgage rates got to 12.5%, and you just didn't think much about it because it was just super high, and that's how it was. And then we've had this 35+ year drop in rates, and especially the last 10-12 years, it's which just seemed unrealistic. That's why you and I talked about one time. I mean, will the Fed someday, and I don't think they will, but
Raise the target.
will they ever change their say, oh, our target's changed now? I could see it, especially in an election year, they might do it.
Yeah.
But man, the
We're good
markets
here.
yeah,
We're
they
good.
do that. Well, we're good
Yeah,
here now. Yeah, it's
I
all good now.
know.
It's
I
all
know
great.
it. And to your point, you looking since the Great Recession, people have gotten used to free money,
Oh
basically,
yeah.
right? Rates near zero. So, I mean, yeah, we've had rate increases, decreases since then. I remember I got in the industry and they were talking about, and they had some rate increases back when Trump was first president. So, um, you know, again, so I want to look at where we're tracking right now in the economy. We're tracking real GDP growth at about 2% annual rate in the first quarter, which is close to the long-term averages. Okay, so we're right on par. Um, and then we look at, unemployment remains below 4%, ticking up close to it with 3.9, ticked down to 3.8, this most recent reading. But in other words, we really haven't seen the economic slump, the downturn, the really big downturn, or even like a substantial reading of jobless claims, unemployment, whatever it may be. We haven't seen that would be consistent with a tight money policy, right? So you brought up 9% mid 2022, right? CPI has fallen to 3.1. It's stopped its decline as of late. So, uh, what are some of the measures that we're going to maybe talk about today? Can you kind of look at GDP nominal versus real GDP? What do you think we should be looking at here as we move forward in terms of his tight policy or not?
Yeah. So I think we should. So let's just say we have great respect for one of our resources for analysis is out of First Trust. A gentleman by the name of Brian Westbury, who comes out with a Monday morning outlook every week, and
Yes.
I'd like to share some of that. In fact, maybe I don't know, Jason, maybe we could put this on the website or something and share this with
Yeah.
people. But he goes in fairly highly respected economist from First Trust. And I'm just going to read straight up where basically he makes this. Ultimately, there is an ironclad two-part test to determine if monetary policy is actually tight. First, question is, has the economy weakened below trend growth? And more clearly, is GDP falling or unemployment rising? And then second, has inflation persistently declined? If those things haven't happened, it's hard to argue that monetary policy has in fact been tight, right?
Bingo. Yeah.
So he's nailing it right there because neither one of those two things have actually happened. He goes on to say, in other words, we haven't yet had an economic slump consistent with what we would call tight money. That is a part of that. It's really interesting to kind of history. He goes on this history suggests that interest rates, to your point about GDP, which brings us to one signal of monetary tightness that hasn't yet been triggered. History suggests that interest rates should be roughly equal to nominal GDP growth, which is real GDP growth plus inflation, minus a cousin to what they call the Taylor rule. Nominal GDP so far is up 5.9% in the past year and 6.5% annual rate in the past 2 years. Yet the federal funds rate is still just 5.4%. If that's not tight, he says that's not tight money. Maybe that's the measure of tightness we should have been following all along, but we have not. So with those numbers, it's looking like we really haven't been in a period of time, and this is one economist's opinion, but
Yep.
something that we're, then more and more looks correct is that we've not been in a period of real tightening. Yes, it's tighter than it was, but not tight enough to actually draw,
Really curb inflation.
again, unemployment, increase unemployment, all those bring GDP down, all those things, right? So all that to say is that it looks like, again, the question comes up. I had somebody ask me, well, do you think, are they going to raise rates? Are they going to totally turn around and possibly the Fed, 6 months from now is going to have to say, oh, wow, we already went too far? We don't think that's the case. And that would be not a very positive things for markets. If we had to raise rates again.
Yeah.
It just means that, again, it looks like at this point, the Fed has to keep rates where they are right now with no cutting until there's clear signs that we have some decrease in,
Steady downward.
economic
Yeah.
activity, higher, unemployment, and those things that we're talking about. So yeah, higher for longer. It's all that to say again, it looks like we're not gonna see interest rates come down, and it'll be interesting to watch that 10-year Treasury yield to see how that continues to play around, especially around this 4.5%, which will be kind of key to see if it can hold that area.
All great points. It's something that we've been talking about and watching. We've always, I'm a really optimistic guy. I hate talking about, pessimistic things or like, things are not going to be okay. We get through tough times, we push forward, but it's something that as fiduciaries as we are, we need to be wary of like, hey, maybe this is a pretty well known, like you said, opinion that we respect. It's actually the most read newsletter in the industry. It's client approved too. So, if anybody
Yeah,
wants it, we can send it to you. But again, I mean, if you're looking at it rates need to be equal to GDP growth plus inflation, nominal GDP. And we're not there. 4.4 is not, 5.9 or 6.5, not anywhere near that kind of benchmark that we look at. So like you said, I think the Fed is going to be very cautious moving forward. There's no reason to cut rates at this point, especially with the economy still humming along the way it is. We're right on trend with those long-term averages.
yeah, for sure. So the question is, so what does that mean for investors right now, right? I mean, that's kind of the question. It's like, oh, that all sounds good. You guys are all, get it higher for longer, but how does that affect my portfolio? What are your thoughts on that?
So this is not, I'm going to proceed that by disclosure stating that these are not investment recommendations and that each individual situation is its own. And each client is their own with their own goals and, needs. So with that being said, I think in terms of equities, if rates were to go up, that would obviously be a headwind. That would hurt corporate profits, which obviously drive long-term stock performance. So that could be a headwind. Ones that just saying in general here that stocks that consumer staples, stocks that can kind of weather or pass along higher costs to consumers, or products that people need, diapers, soap, whatever it may be, food, kind of those staples that aren't really going to go away dependent on consumer spending habits. Those stocks will be able to weather an economic downturn a lot better, historically speaking. And then bonds, if rates go up or yields have gone up recently, that will be a headwind for the bond market as well. So you have two asset classes that normally are not correlated. They usually act in opposites somewhat. They've actually, more recently, as we talked about in our breakfast this week, they've been very correlated. They both go up at the same time, both go down at the same time, which is, in a retirement account or 60-40, let's use a traditional aspect, tends to, you don't want that kind of movement, that kind of parity. So we've actually been looking at alternative investment strategies that could maybe lower risk, the risk profile on downturns or downdrafts in the market. And that can maybe smooth out the volatility curve. And whether it's, again, because law of mathematics, I want to mention this on the podcast. We talked about it this week. If you lose 10% in your portfolio, you need to make up 11.11% to get back to square one, right? If you lose 20%, you need to make back 25%. If your portfolio goes down 50%, you need to make back 100% to get back to square one. So it's not down 10, up 10. That's just not the law of mathematics. So we really want to be conscious and thoughtful investors for ourselves, for our clients that basically will be able to weather different market cycles, which is something that you've taught me and you've preached since as long as I've known you, really.
Yeah. Well, it's again, balanced portfolio a little bit. And I think the alternatives, especially new, because the products that are coming out now in these ETFs, First Trust has a number of them that we're talking about more. Things that, used in the, 10, 15 plus years ago were all just for, the big institutional
endowments.
investors, the big endowments, the schools that have all this money, and you can see that they've used private equity, hedge funds, all types of things
Private credit.
that
Yeah.
try private credit, all these things, mostly illiquid investments that have not really, and high, high levels to get into, like big
Yeah.
money that you can't get into, that now have been sort of packaged and put into ETFs and funds now that can really perhaps provide that alternative um, piece that actually reduces the risk, the overall risk of even a 60-40 portfolio. But I'm
Hmm.
not, I'm not over the 40, and again, back to stocks and bonds, they have been correlated lately. That won't last forever, but at this
Hmm.
time, it's still there. So I'm telling clients too, I mean, again, if your cash needs are shorter term, then you should be in short-term duration kind of bonds, right? So, ultra short, things that kind of are that,
Right.
3-month T-bills kind of stuff. Areas that are really stable from a principal value, but
Yeah.
you can get 5+% now in these short-term accounts that are really positive, and then start to build your barbell out with your fixed income. So if again, if you needing money and you think you're going to need money here soon, the shorter duration right now is really probably the place to be. But boy, at some point, if rates if rates eventually do start coming down and we get what we expect here in the next, now, I would say 12, 18 months, we should be, that should be a great investment. We talked about that earlier this year, is that, the expectation would be very positive for bonds and bond funds and duration wise, but that's not panning out at the moment. And who knows when it will at some point. But
Nope.
right now, again, you just got to look at your portfolio, make sure that you're well diversified. Like, to your point, it's what I've always preached.
Yeah.
Got a really well balanced portfolio, all weather
Yep.
portfolio, that you have pieces of investments in lots of different things, including now the alternative investments. I think it's a great opportunity for some clients, not everyone, but some.
Great points. That's all we have for you this week in the closing bell. We'll see you next week. You guys have a great weekend.